Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report from AB Private Credit Investors Corporation. It's about a new financial deal they've made. It involves a lot of financial jargon, so buckle up, we are going to turn this into an understandable story. The big news is that on March 21, 2025, one of AB Private Credit Investors Corporation's smaller companies, AB PCIC Funding VSLC, got into a new agreement to borrow money. This is called a warehouse financing transaction. Think of it like a line of credit that the company can use when it needs money. This agreement is really a bunch of smaller agreements that all work together. It is used to borrow money and manage the borrowed money. One agreement is the actual loan agreement. It's between the borrowing company, the people lending the money, and a few companies that are managing the loan. These include AB Private Credit Investors LLC, which is managing the assets, NatWest Markets PLC, which is the main lender, and US Bank Trust Company, which is holding the assets as security. Another agreement controls the bank accounts where the money is held. It makes sure everyone agrees on how the money is handled. Then there's an agreement where AB Private Credit Investors Corporation sells some of its assets to the borrowing company, the borrowing company use those assets to get the loan. Finally, there's an agreement where AB Private Credit Investors Corporation promises that if the borrowing company can't pay back the loan, the lenders can take some of AB Private Credit Investors Corporation's assets as payment. So how much money are we talking about? The loan agreement lets the company borrow up to $75 million. The interest, or the cost of borrowing the money, is based on a standard rate plus an extra 2%. The interest is paid every 3 months. The loan has to be paid back by March 21, 2032, which is in about 7 years, or if something happens that makes the loan due earlier, according to the agreement. There are rules about borrowing under this agreement from the Investment Company Act of 1940. This is a law that protects investors. The loan is secured by all the things the borrowing company owns and by AB Private Credit Investors Corporation's ownership of the borrowing company. Basically, if the loan isn't paid back, the lenders can take those things. The company managing the assets has decided not to charge any fees for its work. However, the borrowing company will pay back any costs the manager has, except for normal office cost. The borrowing company has promised to follow certain rules and give regular reports, as is normal for these kinds of loans. The things that are promised as security for the loan are held by a company called the document custodian or the securities intermediary. The collateral agent will manage those assets and get paid regular fees for doing so. AB Private Credit Investors Corporation has already given or sold some assets to the borrowing company. It might continue to do so in the future. AB Private Credit Investors Corporation can also buy back or trade certain assets as long as it follows the rules in the agreements. AB Private Credit Investors Corporation had to pay some normal fees and costs to get this loan agreement in place. This agreement allows AB Private Credit Investors Corporation to create a way for the subsidiary to borrow money backed by assets. The report also mentions that because of this deal, the company now has a direct financial obligation, meaning it owes money. It is an obligation under an off-balance sheet arrangement, which means this debt is held by the subsidiary and is not directly seen on the parent company's balance sheet. The full details of these agreements are available in the exhibits attached to this report. It contains the complete legal wording of each of the agreements that make the warehouse credit facility. Now let's take a step back and look at the bigger picture. AB Private Credit Investors Corporation is using this financing deal to get access to more money. This can help them grow their business and make new investments. One risk to keep in mind is that borrowing money always comes with the risk of not being able to pay it back. If the borrowing company can't make its payments, the lenders could take control of its assets. The complexity of the financial agreements adds another layer of risk. If something goes wrong, it could be difficult to sort out who owes what to whom. However, there are also opportunities here. If AB Private Credit Investors Corporation can use this money wisely, it could lead to higher profits and growth. It's all about managing the risks and making smart decisions. The key takeaway is that AB Private Credit Investors Corporation is making a strategic move to increase its financial flexibility. Overall, AB Private Credit Investors Corporation seems to be in a decent position. They're taking on some risk by borrowing money, but they also have the potential to grow and improve their business. Whether or not this deal pays off will depend on how well they manage their investments and navigate the financial landscape. Thanks for watching. If you found this breakdown helpful, please like, comment and subscribe for more corporate deep dives.